I'm going to share with you guys today the 5 biggest mistakes that I have seen limited partners make on how they think about investing in real estate deals. Why does this matter? I am a general partner and sponsor. I run over $150 million of real estate. We are continuing to acquire great properties. I have never personally invested in someone else's syndication, but knowing what I know on my side as an expert in this business, I want to share with you the 5 things that I think all limited partners need to be mindful of. Mistake number one, going all in on one deal. Never do it. Never do it. I don't care how trustworthy, honest, good looking the sponsor is. I fit all those qualifications, by the way, so I always tell people, hey, slow down. Don't do the max. So I've had LPs say to me, I really like this deal, Ari. This is a good one. I want to go on this one. This feels like the one I should invest a lot of money in. And I always say, slow down, do the minimum. Please do the minimum. Tangential to that, never invest money you need in the next 3 years. This is not one of the 5 mistakes, but I have to make sure to say it. Don't invest money you need in the next 5 years. It is never worth it. Spread your bets out. Spread your bets out. Better yet, spread your bets out to different sponsors. Spread your bets out. Don't go big on one deal because the sponsor is really adamant that it's good. Number 2, understand vintage risk. This is controversial to say, I guess, but who cares who the sponsor is? The vintage being the year of the investment, is probably one of the biggest determinants of return out there. I am not advocating for market timing or thinking about market timing, but what I can tell you is this. People got excited about real estate investing between 2021 and 2020, call it like 2023. People were excited. It was easy to raise money. I was doing it. It was easy to raise money. But if you had gone all in on real estate in that time, this is different. Even if you've spread your bets out, if you've gone all in on real estate in 1 calendar year or even a period of 2 calendar years, it is not good. This really ties back to point one. It might be a great vintage. Great vintages, 2010 through 2015. Anything done in that period, it made money. You could be the worst investor of all time, and you would have made money most of the time in real estate in that period. If you were investing with the best investor of all time in 2021 in Texas on a bridge loan, you probably lost money. I don't care who the sponsor is. Be mindful of your vintage risk. Spread your bets out, do the minimum, and invest in various vintages. Vintage, in my humble opinion, drives more of the return than anybody on my side likes to really talk about. It is the truth. Be mindful of vintage risk. Number 3, be mindful of the investor operator incentive structure. Okay. Understand their fee structure. Understand the alignment of interests. Understand if the sponsor has some vested interest in acquiring the building for their own monetary purposes. They need the money. They need to close something. This deal looks great. They underwrite it nicely. It's not a good deal, right? Understand the incentive structures. Maybe they have in-house management, which, by the way, we do. I think it's great. I think it's a fantastic aligned model. But understand the model. What if your sponsor is also a developer and they just are desperate for money because they have failing deals elsewhere? What if they want to hold on to the deal and milk it for fees? Get the incentive structure and understand it. It doesn't mean that it's wrong or it's bad, but understand the alignment of incentives for your sponsor and how they're making their money. Mistake number 4, not vetting operations capability. People in this business are fantastic salespeople, right? I'm a good salesperson. Try to be humble? I guess not. I'm a good salesperson. If you're successful in this business, you are a great salesperson. But being a good salesperson does not mean you are an operations expert. Operations drive a lot of the returns. Number 1 driver, vintage. Number 2 driver, the location. Number 3 driver, very, very important, debt, which I haven't really talked about here, but we'll talk about another piece. But debt is really important. Understand the structure of the debt. But number 4 driver, the operations execution. You could have 2 deals, the same deal in the same metro, side by side. And if you have a bad operator and a good operator, the good operator will outperform every time, all else being equal, right? Bad operators did really well in 2010 to 2015. That's your vintage, right? It drove those returns. But spend some time when you're assessing a deal to ask deep questions about their operations capability. How do you manage a management company? Do you run your own management company? Talk to me about your leasing process. Talk to me about how you get non-paying residents out of your building. Talk to me about how you compress costs. I had a fantastic operator one time say to me, the key to winning in real estate, buy cheap and swarm the financials like ants. I love that metaphor. It's awesome. Swarm it like ants. Ask your sponsor, whoever you're investing with, how do you manage the financials? How do you audit and make sure you're not getting ripped off? How do you control your contract? How do you compress cost? Operations execution is critical. Nobody ever asked this question. I have been in hundreds of discussions with limited investors. They never ask this question. They always ask other questions, which I'm going to get to now. Mistaking IRR as the end all be all metric to drive real estate returns. Let me tell you something. IRR is a wonky, not particularly trustworthy metric, but everybody loves it. And because LPs know it, they love it, they trust it, sponsors, myself included, lead with IRR. And it's not because IRR is bad, but you have to understand the pitfalls of IRR. I've had many people with a lot of experience in this business say to me, they don't even rely on IRR in making an investment decision. They don't even look at it. Think about that. They don't even look at it, yet it's the only thing LPs focus on. There's so many more important parameters to a successful real estate investment than what the theoretical IRR is. And why is it theoretical? It is highly dependent on the exit cap rate assumption. If the sponsor makes an aggressive assumption, it will move IRR multiple percentage points. But is that assumption right? It's kind of like a finger in the air. Don't use IRR as your assessment metric. Learn the other metrics. Understand the cash flow of the deal. Understand how the cash flow actually flows. When is it supposed to hit? What does it take to get to the point where the building is actually producing a real return? I like deals that cash flow out the gate, right? And I'm going to do another piece on this about, the lies of cash flow in this business, because there are many lies and not all cash flow is equal. But I would want to understand those things. What is the equity multiple? What is the time, the hold period? Many sponsors, myself included, underwrite to shorter investment timeframes for two reasons. One, investors don't love to be in deals forever. Two, it increases the IRR. Yes, IRR is a time-weighted metric, which means it's highly sensitive to what I tell you the time frame of the investment will be. So don't look at IRR, please, for all of our sakes. And by the way, sponsors know this. We talk about it. We don't love it. We all understand there's serious limitations to IRR. It is the LP community that insists on looking at IRR. So IRR keeps going in the same direction. Bonus mistake, concentration risk in one area. You're in Texas. You love Texas. You put all your eggs in Texas. Texas tanks. Texas just tanked, by the way. It's not doing great. The Sunbelt, really bad. But there was a period of time, and now you're kind of coupling two huge risks. You're coupling vintage and you're coupling market concentration risk. If you went all in on the Sunbelt, 2021 to 2023, and you went all in the Sunbelt, you were getting double whammied. You were getting smacked by vintage and you were getting smacked by location. So if you're an LP and you're thinking of a diversified real estate portfolio, please invest in multiple markets. It can save you. I remember looking at Denver very closely in 2022, and every single deal was a 3-cap. 3-cap purchase, and every broker very confidently said, Ari, all you got to do is underwrite to a 4.25 cap exit. That is very conservative for this market. And meanwhile, Portland and Seattle, other markets we love to invest in, had very, very different numbers. And I eventually just said, I'm not going to do Denver. I'm going to go elsewhere because I'm looking at multiple geographies. Looking at multiple geographies saved us. We would have gotten our shirts handed to us, I think is how you would say it, if we had just been Denver, guys. As an LP, take the same methodology. Look at deals from different markets so you can start to suss out where's a good deal, what market's overheated. Be very wary of concentration risk in one municipality. I want to leave you guys with that. I have a lot more content coming on the Timeless Investor Show where we cover historic financial analyses, great builders, the villains, different booms and busts over the history of humanity from the beginning, right? We just did an amazing piece on the 30-year war and the Kipper and Whipper crisis. We're covering some great stuff here, but I also want to share with you guys each Wednesday a deep dive tactical video analysis like this, where we discuss my learnings from the trenches running a 500 plus unit portfolio across the entire US West Coast. Thank you. Think well, act wisely, build something timeless. Thank you.